Yeah, hello, ladies and gentlemen. It probably surprises you what my first sentence will be. It is welcome back to the channel. You successfully survived last lecture, probably. That was the importation from third countries, part 5. And now we are going to go on, and this is now part 6, as you might have expected. So, where are we now? We are here at the bottom. After some special schemes or regimes for certain situations, there is one which is also interesting to be mentioned. That is the IOSS scheme. That's not an international space shuttle thing, but it is the importation one-stop shop solution. And let us first, before we talk about that, explain where the problems are and why such a special solution had to be designed. Well, let's begin at the beginning. So, if we have a seller who pays VAT on the border, the place of delivery, you remember that, is shifted to the inland by that special rule of 3.8 USDG. The background was the seller can claim input VAT refund for the importation VAT, so that would be senseless if you give it back if you don't secure taxation, final taxation in a different way. That was the reason behind 3.8. So, in the course of time, our seller, vendor, or however you call him, supplier, has also to pay the regular VAT under 11 number 1 because it is a delivery now 3.1 and the place of delivery is in the inland. So the final VAT is paid in the country of destination by the seller. That is exactly the right outcome under the basic principles. So that's all fine. If it's the buyer who pays the VAT on the border, then the usual rules lead to the following outcome. 3.8 does not apply. The normal rule would now be 3.6. The place of delivery would be where the movement of the good towards the customer began, that is, in the third country, because the good comes from there to the inland. And if the place of delivery is in the third country, then the outcome of testing 11 number 1 is very simple. We have a delivery now 3.1, but the place 3.6 is not in the inland but outside the EU. So the sale is nowhere taxable in the whole EU. Also, that is a fine result because the buyer pays a net price to the seller, pays VAT to the customs authorities, and takes the good home and uses it. So also then everything's fine. The country of destination gets the money, nothing which needs to be changed. Now, nowadays it can also happen that an importation of a good coming from a third country is done, let's say in Germany, and the good later goes on to another country. Then everything under these normal rules would go and could go wrong. Imagine, for example, that a good comes from Switzerland. It is transported towards France because the final customer is in France, it's a private person. However, the importation VAT is not postponed but declared on the Swiss-German border. So the importation VAT is paid by the deliverer at the German border, naturally to the German fiscal authorities. In such a case, the importation value-added tax will then be 19%. It will be paid to Germany. However, the good goes to France, and under the principle of taxation in the country of destination, the tax should go to France and it should be taken at the French rate. That goes wrong now. Furthermore, also if we apply 3.8 USDG, the place of delivery would be shifted to Germany, not to France, because it is under 3.8 that country regarded as the place of delivery where the importation VAT had been paid. So that's great shit. Everything goes wrong. Germany gets a tax, although France should get it. So that's evidently a wrong result. And in contrast to former times, when we did not have many cross-border transaction with private customers. This is today a very frequent event, and so for this reason we need to correct this. So if the good which is sold to a private customer does not stay in the country where the importation has been declared, then the place of delivery is no longer shifted under 3A to the country of importation, but it is shifted to the state where the good ends up at the end. That rule is 3C, paragraph 2. Now, on the other hand, if it's a private customer who pays the importation tax, that will be, by the way, very seldom in such cases. It will also be wrong if the private customer pays the importation VAT to Germany, but then the good goes to another state. So for this reason, the rule of 3C2 is also applied to these cases. Also in these cases, the place of delivery for the supplier is shifted to the country of the final customer. So that makes it necessary for you to, that automatically leads to always the taxation in the country of the final customer in these distance sales cases from a third country where the good does not stay in the country of importation. Now, if you are a supplier who has to do with such importation cases, who makes delivery transactions where the good comes from the third country to one of the member states, you might then end up with becoming taxable in 27 member states of the EU. So under the normal rules, that would mean you would have to register as an entrepreneur in 27 member states of the EU. Which would entail an enormous bureaucracy. That's intolerable. And so one needs to find a simpler solution how you can deal with the tax declaration duties. And for that reason, the EU has created a possibility for the suppliers in question to just make one single tax declaration where they list all the transactions done to each individual member states with the corresponding tax. So you hand in one single tax declaration where you say, Bulgaria, I sold for 100 euro net plus their tax. Germany, I sold for 2,000 euro to private customers plus appropriate tax. Belgium, the Netherlands, and also everything in one single sheet of paper, or more realistically, in one single electronically submitted document, tax declaration, which is then presented to one single fiscal administration only, which works on it and then collects the tax and distributes that money to all of the member states on the list. So Bulgaria gets the tax on the 100 euro net according to their rate, Germany on the 2000 according to their rate. So this scheme is called a one-stop shop system or regime or scheme. And as this also exists in other areas, this is particularly named the Importation OSS scheme or IOSS scheme. It also entails the good effect that you don't need to register in 27 member states with your business, but only once for the IOSS scheme. You get a special identification number there, and then that's it. So that is your taxpayer's number under which you can write out invoices then. However, that IOSS scheme is basically only allowed if the tax claims can afterwards be sufficiently enforced against the state where you live. So uncomplicated is that in cases where the supplier is somebody who has business in the EU, that can, remember, that easily happen if you run an electronic portal or electronic marketplace, then you are deemed to be the supplier of the third country good which comes to the inland. So you are in the EU, probably you get taxable with your sales in another member state, and so you can make use here from the importation one-stop shop system. Or if the supplier of the goods is resident in a country which cooperates sufficiently with the tax authorities of the country where you hand in your tax declaration, everything is fine too. Or if that's not the case, you still have a possibility to make use of that scheme if you appoint a fiscal representative or fiscal agent, however you call him or her, in one of the member states of the EU, who takes over the fulfillment of all your fiscal obligations towards the fisc. So basically, probably everybody can make use of that IOSS scheme if they fulfill the correct conditions. There is, however, now a last curiosity, a last thing which should be solved. You have probably in mind that these rules which are described now were designed for the case where the good ends up in a different country than in the country of importation. Basically, when it stays in the country of importation, these rules did not apply. Now that makes absolutely no sense under a practical aspect. If you can make use of the IOSS scheme for the deliveries to all 26 other member states in Germany, but would have to declare your distance sales to Germany under the normal rules, that would make things more complicated than they could ever be. And so the rules say if you make use of the simplified scheme, the IOSS scheme, then also for the deliveries which stay in the country of importation, the IOSS rule is applied. The place of delivery is then always shifted to the country of of the customer. So that is, in that case, for example, if you import in Germany, then the customer is in Germany, then the country will also be Germany. And in contrast to 3.8, that would no longer depend on who will pay the importation tax. So then you would have a consequent replacement of 3.8 by 3C2 and 3C3, and you have a consistent system. However, please keep in mind that this whole IOSS scheme only applies if you have a distance sale from, or if you have a sale from a third country to the inland, and if your customer is what we simplified call a private person, a person defined in paragraph 3A5 sentence, I don't know what, 4 or 5. So either a private person or a taxpayer who is not liable to acquisition tax and other things, which we are going to discuss far, far later. Yeah, that was my introduction to this particular thing combined with imports. And I think now we have reached or discussed so many special rules concerning import and exports from third countries that it becomes time to practice a bit. And so the next videos will probably deal, if I don't get run over by a bus or change my plans, so the next videos will in all probability deal with some exercise cases. Till then, recover well, enjoy that it's over for today, or enjoy that you enjoyed it. Press the like button if you want to, and under all circumstances, come back when the next video comes out and remain faithful to the channel. Thanks for watching and goodbye for today. So, and then I'm genuinely sorry that I still have to add a last remark. Naturally, when that IOSS scheme applies, then goods where the single package has a value of not more than 150 euro will automatically then be freed or exempt from importation tax, because then it is sufficiently guaranteed that the good cannot reach the customer untaxed. And so the fiscal authorities then renounce on taking the importation tax. That rule can for Germany be found in paragraph 5 number 7 of the USDG. That is one of the cases where importation, or that is the rule with a list where importation VAT is exempt. Okay, now that was the final remark. I forgot it. I apologize for that. Thank you again for watching. If you have not done it yet, press the like button and recommend the channel to others, and you know all that stuff which you should never forget. Now, definitively goodbye for this time, and see you again soon if you are willing to. I would be delighted if you come back. Thanks. Goodbye. Till next time.